Bollinger Bands are not a magic signal. I treat them as a simple way to measure whether price is moving quietly or stretching away from its recent average. That is the real value of the tool. It gives traders a visual frame for volatility, not a prediction machine. If you understand that, you avoid most of the mistakes beginners make with it. At the basic level, Bollinger Bands are three lines on a chart. The middle line is usually a moving average, which smooths out recent price action. The upper and lower bands sit above and below that average by a distance based on volatility, usually measured with standard deviation. In plain English, when price swings get wider, the bands expand. When price gets calmer, the bands contract. The formula is doing one job, showing how unusual the current price move is relative to recent behavior. Traders use Bollinger Bands in a few common ways. Some watch for price touching or pushing outside the bands and assume the move may be stretched. Others look for the bands to narrow sharply, which can signal a quiet market that may be preparing for a larger move. I also see traders use the middle band as a rough trend guide. If price keeps holding above it, the market is showing strength. If it keeps failing below it, weakness is more likely. None of these are automatic entries. The biggest beginner mistake is treating the outer bands like reversal lines. Price can ride the upper band for a long time in a strong uptrend, and shorting every touch can be a fast way to lose money. The same problem happens in downtrends on the lower band. Another common error is using Bollinger Bands alone, without asking what the broader market is doing. A band touch in a choppy range means something different from a band touch during a strong breakout. Context matters more than the indicator itself. If I were teaching someone to use them responsibly, I would start with three questions. Is the market trending or ranging? Are the bands expanding or contracting? Is price respecting the middle band or rejecting it? Those answers help me decide whether the bands are showing momentum, compression, or exhaustion. For example, in a range, a move to the upper band may be a reasonable place to look for a fade. In a trend, that same move may simply confirm strength. Where Bollinger Bands tend to work best is when volatility changes are meaningful and the market is not moving in a straight line. They are useful for spotting compression before expansion and for giving structure to a chart that otherwise looks noisy. They tend to fail when traders expect precision. The bands do not tell you exactly when to buy or sell, and they do not protect you from news shocks, breakouts, or trend days that keep running farther than expected. My view is simple. Bollinger Bands are best used as a frame, not a trigger. They help you ask better questions about price, volatility, and trend. That is valuable. But if you want them to do the work of a full trading system, they will disappoint you. The traders who use them well combine them with market context, risk control, and patience. The traders who use them badly confuse a visual guide with a forecast.